So, welcome to the fifth episode of our series on basics of leasing. Today, we'll be talking about the tax aspects of lease transactions, tax meaning income tax aspects of lease transactions. We would begin by first discussing the much discussed, much debated, and quite often much confused understanding of what's the tax economics of lease transactions. Mostly people tend to think that leasing results into tax shelters. Leasing results into tax shelter for the lessor. Very often, a lot of people believe that leasing results into tax shelter for the lessee. And some people surprisingly believe that leasing results into tax shelter for both the lessor and the lessee. Now, let's first try understanding what is the inherent tax shelter in a lease transaction. If I was to do a loan transaction, if I was a lender, in which case I do not claim anything called depreciation. I pay tax on my interest income and that's it. I simply pay tax on my taxable income is the interest income. Of course, I have expenses to claim against it, but I have expenses in any business. I have expenses in leasing business as well. So the taxable income is the interest component. In case of a lease transaction, I claim depreciation. There is a very common word used in practice called accelerated depreciation, AD, or accelerated depreciation, meaning there are certain assets where depreciation rates are significantly high. For example, pollution control devices, energy saving devices, etc. Sometimes IT equipment also. The depreciation rates are high, so people think depreciation itself is significantly high. Therefore, there is a benefit of accelerated depreciation. For the lessor is therefore claiming benefit of depreciation in case of lease transactions. What about the lessee? What's the lessee claiming? Had the lessee opted for a loan transaction, the lessee would have claimed number one, depreciation, because the lessee would have then been the owner of the asset. He would have also claimed interest on the loan. The interest expense would have also been claimable as an expense. So the lessee would have claimed depreciation plus interest. Therefore, from the lessee perspective, what would it actually be? It would be interest plus depreciation. Let me just try getting some annotations here. Okay, I'm missing the annotation tool, but nevertheless not a problem. The lessee would have claimed interest plus depreciation. Let me write so shabbily on the screen. Lessee would have claimed interest plus depreciation. That's how badly I can write, not worse than this. And the lessor would be claiming depreciation. In case of a lease transaction, lessor would claim depreciation. In case of a loan, there's no question of depreciation at all. The lessor would have paid tax on the interest income. Therefore, the taxable income for the lessor would have been the interest component. The taxable expense for the lessee in case of a loan would have been interest, right? You can see there is a clear sort of reciprocity between the lessor and lessee here. Lessee would have claimed interest plus depreciation in case of a loan transaction. Lessor would have paid tax on the interest in case of a loan transaction, which would have been the taxable expense of the lessee. Lessor's income would have been interest. Lessor's income would have been interest, and the lessee's expense would have been interest. Lessee would have claimed depreciation, which in case of a lease transaction gets shifted to the lessor. You can see this is exactly what is getting shifted to the lessor. Therefore, leasing has shifted depreciation to the lessor. As regards the interest expense would have been the expenditure of the lessee and would have been the income of the lessor had it been a loan transaction. But the moment you talk about a lease, instead of interest, what becomes taxable in the hands of the lessor would be rent. the lease rental. So the rental will be the taxable income of the lessor, and the rental would also be the tax expense of the lessee. The moment you talk about a lease transaction, what is the income of the lessor? Rental. What's the expense of the lessee? The rental. What is the depreciation claim at the lessor? Is exactly the depreciation that is forgiven or sort of given up. Given up by the lessee gives it up, lessor claims it. Lessor pays tax on rentals, which is expensed by the lessee. That's the reciprocity between the two. Now let's try understanding. The lessor pays tax on rental in case of a lease transaction. Rentals comprise of two parts. Rentals consist of two parts. Number one, principal plus interest. Therefore, interest would have been taxable in case of a loan transaction. Interest is taxable in case of a lease also, because the interest becomes a part of the rentals. To the extent interest is therefore a common factor, we can eliminate it from discussion. Therefore, what additionally becomes taxable in the hands of lessor is the principal component of the lease rentals. What is therefore taxable in the hands of lessor is the principal component of the lease rentals. And what is additionally deductible by the lessor is the depreciation. Therefore, lessor deducts depreciation, and lessor gives up by way of an incremental tax liability, tax on the principal component inherent in the lease rentals. Now, please try understanding, over the tenure of the transaction, if you're talking about assets worth 1,000 rupees, what is the total principal component? Assuming it's a full, at some stage it would be full payout anyway. Every lease will be full payout at some stage. So if you're talking about an asset costing 1,000 rupees, what is the total principal component over the tenure? Well, it will add up to 1,000 rupees. Therefore, the total additionality introduced in having to pay tax on rentals, which consists of principal also, is equal to 1,000 rupees. In other words, can I say that lessor introduces further additional taxable income to the extent of 1,000 rupees? And over a period of time, he would also claim depreciation equal to 1,000 rupees. End of the day, that is end of the life of the asset, lessor would have claimed 1,000 rupees by way of depreciation. He would have additionally exposed 1,000 rupees by way of income, because rentals would consist of the principal component as well. Therefore, if you look at the sum total over the years, a lease transaction neither does a tax benefit nor does a tax damage to the lessor, because the additional taxable income equals the cost of the asset, and the depreciation claim also equals cost of the asset. Therefore, over the years, the tax benefit and the tax loss are both equal. However, these two are not equal year by year. They're equal over the years, but they're surely not equal year by year, because year by year, the principal component will not be the same as the depreciation on the asset. Principal component, I'm sure you understand, it increases over time. Depreciation decreases over time. Depreciation is claimed at a certain rate given by tax laws. And therefore, the time period over which depreciation would be 100% claimed will depend on depreciation. It might take years. It might take 20, 25 years to claim, to depreciate the asset fully. It might take lots of years. But some people might probably think, oh, the asset life is only 3 years or 5 years, therefore I should actually depreciate it over 5 years only. That's actually a misnotion. That's a mistaken understanding. I'll explain that in a minute from now. So depreciation will be claimed over a long range of time. In any case, it's on a declining basis. Principal component of lease rentals is increasing over time, and is constricted or restricted to only the lease tenure. Therefore, the true tax economics of a lease transaction for the lessor is, to the extent, or if at all and to the extent, the present value of the depreciation exceeds the present value of the principal component inherent in lease rentals. This is a very, very important principle for understanding the economics of lease transactions. It's a very important principle. Therefore, I'll state it once again. If and to the extent the present value of depreciation meaning depreciation as per tax laws. When we're talking about tax benefits, we're talking about tax depreciation. The present value of tax depreciation exceeds the present value of the principal component inherent in lease rentals, then, and in that case, and to that extent only, will the lease mean a net tax advantage to the lessor? For the lessee, it's exactly contrary because the lessee deducts rentals, the lessee foregoes interest plus depreciation. Therefore, for the lessee, the economics is exactly contrary. If the present value of principal repayment inherent in lease rentals is higher than the present value of depreciation foregone by the lessee, then the lease results into a tax shelter for the lessee. And I'm sure you can also intuitively understand that if the lease means a tax shelter to the lessor, if the lease means a tax shelter to the lessor, it would thereby mean a tax loss to the lessee. No lease can be advantageous to both the parties. It may mean either a tax shelter for the lessor, in which case it's at the cost of the lessee, or it may mean a tax shelter for the lessee, in which case it's at the cost of the lessee. This is invariable tautological rule. This rule has no exceptions at all. There might be exceptions because of tax rates, or there may be exceptions because of taxability itself. But assuming both parties are taxable, this rule holds universal applicability with absolutely no exception. This rule is not limited to India. The same rule extends all over the world. Now, I've talked about the basic economics of lease transactions when it comes to taxation without even discussing the tax implications of lease transactions. But at this stage, let me quickly first discuss the tax implications for lease transactions. All along over the last 4 episodes, we've been talking about financial leases, operating leases, in some cases capitalized in the books of the lessor, in some cases capitalized in the books of the lessee. For India's entities, in any case, the asset is not capitalized. What's capitalized is the ROU asset. The ROU asset is depreciated for accounting purposes. Is there something called ROU asset which is depreciated for tax purposes also? But please understand that the moment we shift to tax aspects, we're talking about taxation rules. Taxation rules are not dictated by the accounting standards. Accounting standards may talk about an ROU asset coming on the books of the. There's no ROU asset which is depreciable for tax purposes. Therefore, taxation completely disregards accounting treatment. Lessor may be treating asset as a fixed asset. Lessor may not be treating the asset as a fixed asset. For example, the lease may be financial lease. Taxation will not be impacted by the accounting treatment. Taxation, however, will be impacted by, is the lessor beneficially and in terms of, let's say, real equitably and beneficially, in terms of equity in the asset, is the lessor beneficially entitled to, does the lessor hold economic ownership of the asset? Therefore, for tax purposes, what is important is the lessor economically beneficially the owner of the asset, or is he simply holding title by way of security? To the extent is simply holding title by way of security, lessor would not be able to stake claim for depreciation. For example, in case of hire purchase, retention of title happens in case of hire purchase as well. The financier is the owner in case of hire purchase as well. But do we say that the financier in case of a hire purchase is entitled to depreciation? Answer would be no. This was clarified long time back, 1943, long pre-independence. There was a circular by the then Central Board of Revenue saying, in case of hire purchase, the financier will not be eligible for depreciation and the hirer will be eligible for depreciation. Why? Because the retention of title by the financier is merely for the sake of security. So if the lessor holds economic ownership, what is economic or beneficial ownership? Man, really speaking, you must be invested in the asset. Lessor should really be exposed to or invested into the asset, not merely holding the shaft of legal title. A mere shaft, a mere what do you call facade of legal title, or mere husk of legal title will not entitle the lessor to claim depreciation. The lease, therefore, should be a true lease. In other words, for tax purposes, we disregard financial lease, operating lease distinction, and we look at whether the lease is actually truly speaking. So we're looking at true lease. I must quickly add to say that possibility of the lease being regarded or held as true lease will be stronger in case of operating leases than financial leases. I must make this point very important. In case of operating leases, the possibility of upholding or holding the lease as a true lease will be stronger. Because in financial lease, by your own admission, the transaction is being taken as financial. Because the lessor has treated the lease as financial lease and characterized as such in books of accounts. Therefore, the lessor is admittedly saying that my transaction is financial. I'm into this transaction as a financier. My risk and rewards are financial. So if you are saying the lease is financial and therefore you're not even capitalizing the asset on your books, to go to the tax officer and say that I am not capitalized and yet I should be claiming depreciation seems a very tough proposition. So what exactly is true lease? I would quickly state true lease once again is the essence or the economic substance of the transaction. Some of these features we've been discussing as we discussed legal issues earlier. Some of these come from accounting principles as well. Therefore, what constitutes a true lease? These are indicia or indicators. They can never be a complete or decisive list of conditions based on which the lease would be true lease. What we need to see is, did the lessor really invest in the equity of the asset? Did the lessor actually expose himself to the asset, or the lessor has simply lent money? So some of the attributes or some of the indicia of a true lease may be seen as you can see on the screen there. Number one, the assets are that in you're really intending the assets to come back. You are intending the assets to come back. That is contractually, factually, looking at the nature, the assets are returnable because lessor's ownership over the asset is actually the residual ownership. Lessor's interest in the asset is residuary interest. Lessor's interest is in lease rentals, but that's a consideration for transferring out the right of use. To the extent the lessor is getting rentals, we can say the lessor is actually parted with his right of using the asset for which is getting rentals. So rental is the consideration for not being able to use the asset. Are you with me? Lessor's compensation in form of rentals is that to the extent the lessor is getting rentals, he has transferred away, he has conveyed his right of use. Therefore, to that extent, he's deprived himself of using the asset. So that's actually not for using the asset. That's for not using the asset actually. So the lessor's real economic interest in the asset lies in the residuary interest, that is the right of reversionary interest. Reversionary interest or residual interest is the interest that the asset would come back. And therefore, it's very important the asset should be capable of coming back. What comes back is the asset, not the scrap. What comes back is the asset, not just what you call the illusion of the asset. What is coming back should be the asset and not its illusion. Therefore, really speaking, the asset is returnable. Then the lease, one of the indicators is the asset is returnable. The assets are severable. Assets remain in existence. There is no bargain purchase option. For example, hire purchase. Assets remain identifiable all through. Assets remain movable all through. The lease period is not perpetual. The lease period is certain. There's no perpetual lease period. The asset is not a wasting asset. The estimated economic life is longer than the non-cancelable lease period. It's a combination of accounting principles and legal principles, which we are. I'm once again saying it's not a full circle because it's not a complete picture by itself. These are indicators. The key principle is, has the lessor actually invested in the ownership of the asset to say that I've actually legally and economically I'm owning the asset. I'm not merely holding legal title. So for the purpose of claiming depreciation by the lessor, two basic conditions. Number one, you should be owning the asset, owner of the asset. Owner of the asset, and ownership means not just legal ownership, it's economic ownership. And number two, so legal as well as beneficial or economic ownership. Economic ownership. That's part one. And part two, you should also be using the asset. In what way is the lessor using the asset? The lessor is using the asset by putting it into lease. The lessor's use of the asset is by leasing out the asset. That is, the asset is being used in the business of leasing it out. Depreciation for tax purposes is allowed on what is called block system. That's a very important point. Depreciation for tax purposes is allowed on a block concept. Block concept is very important because a lot of people actually have a confusion on this block system of depreciation. A lot of people have a confusion. Block system of depreciation. What does that mean? Assets become part of a block. To give an example, if I have an asset, say worth rupees 10 lakhs, and I've given it on, let's say I've given it, it may be leased or owned or whatever. Let's say I have an asset worth 10 lakhs. I've been using it. This may even be applicable for self-use assets. Let's say I've been using it. 10 lakh rupee asset which I've been using. I depreciate the asset on a WDV basis year by year. 3 years later, the asset still has a value of 60%. 3 years later, the asset still has a value of 6 lakhs. And I simply scrap the asset. The asset is of no use anymore. The asset is scrapped. What happens to the 6 lakh value left? Question. What happens to the value of rupees 6 lakhs left in the asset? I've scrapped the asset. Let's say I sold it for a penny. I sold it for a song. And therefore, I've got rupees 6 lakhs still left in the asset. What happens to that 6 lakhs? A lot of people tend to think that that 6 lakhs will be allowed as depreciation or loss in the year of sale. No, it's not. In case of depreciable asset, there is hardly ever any question of a capital loss or capital gain on sale of assets or on, let's say, so-called discarding of assets. There's no question of capital gain or capital loss comes only if the entire block is sold or the sale proceeds exceed the WDV of the entire block. Now, it would rarely be so that the entire block is exceeded because mostly the block will have a value. So all that happens is that 6 lakhs will continue to remain in the relevant block. Blocks mean pools of assets. We classify assets as pools, not by the category of assets, but by depreciation rate under 4 broad classes for income tax purposes, namely buildings, furniture, fixtures, plant and machinery, and of course ships, and then finally intangible assets. Under these 4 or 5 major classes, assets depreciable at the same rate will form one block. For example, all the assets eligible for 15% depreciation. I'm sure those who know income tax rules would know most of the assets in real life are depreciable at 15%. Therefore, all the assets coming under plant and machinery eligible for 15% depreciation form one block. So this asset worth 6 lakhs which is still remaining, if I've sold it, that 6 lakh will still remain in the block. The fact that it remains in the block, what does that mean? That would mean now I will not be able to claim it as a loss. But this year and next year and year on year, I'll keep on claiming the relevant depreciation rate, that is 15% rate on that 6 lakhs. I'll keep on doing that for years. In other words, depreciation extends to perpetuity. Depreciation always extends to perpetuity. I'll never be able to, write off the asset completely. On the contrary, assuming the WDV of the asset was 6 lakhs and a sold asset for a value of 9 lakhs, what happens to the 3 lakh gain? Will it be taxable? Once again, no. Unless the sale price exceeds the WDV of the entire block, which I said is mostly unusual. Unless the entire block is exceeded, that 3 lakh also will not be taxed. On the contrary, the entire sale proceeds, that is rupees 9 lakhs, will be deducted from the block value. Therefore, inherently what's happening? The block is further reduced by the gain, that is 3 lakhs rupees becomes a further deduction from the block, and therefore I am taxed by way of a reduced claim for depreciation over the years. So please understand, very important, neither is the loss on sale of asset allowed, nor is the gain on sale of asset taxed. The first one is allowed and the second one is taxed by way of a continuing claim or continuing reduction of the claim over a perpetual time series. Therefore, in essence, the profit or gain is never allowed to tax. And that's a very important principle. And this principle becomes very, very important when you analyze the tax economics of lease transaction. Because for the lessor, who would mostly be leasing out assets depreciable at 15% depreciation rate, it would take perpetual number of years to claim depreciation. On the contrary, the tax on the principal component will be over the lease tenure. Lease tenure will be 3 years or 4 years. Depreciation will go for perpetual series. Therefore, mostly for the lessor, given the depreciation rates in the country, most of the lease transactions, particularly 3 or 4 year leases, mostly a 15% depreciable asset, would mostly result into a tax loss for the lessor. Because this might be a little disturbing point, so I'll maybe disturb you further by stating it once again. Given that depreciation rates in the country, further aggravated by the block system of depreciation, most of the lease transactions in the country, particularly of assets which are eligible for 15%, and most assets are like those 15% depreciation, would mostly, for the lessor, mean a tax loss rather than a tax benefit. And therefore, if somebody says, should a lessor choose financial leases or operating leases, I would mostly say choose financial leases, because in financial leases, you can just, give up the depreciation claim, say, this asset is purely a financial transaction, neither I'm interested in claiming depreciation, and I'll pay tax only on the interest component of the lease rentals. So that's briefly the tax economics of lease transaction. Let me quickly move further to talk about certain further aspects of taxation. I did mention that I will talk briefly on the the car leasing phenomenon as well in the country, because that's a very important phenomenon. I'll talk about that too. So let me just quickly come and talk about that. Uh, right. So depreciation depends on depreciation rates. I'll quickly show depreciation rates so you're able to understand what are the rates like. Here is a list of depreciation rates. That's the list. Furniture fixtures mostly 10%. Plant and machinery 15%. General plant and machinery 15%. Plant and machinery for tax purposes very broad. Everything which is tool of a trade becomes plant and machinery 15%. Motor cars, that is cars, other than those used in business of running them on hire 15%. Those which are used in business of running them on hire, that is taxis or lorries, etc., 30%. Commercial vehicles 30%. Life saving medical equipment 40%. Sometimes these what do you call some of the medical equipment, particularly imaging equipment, may also come in life saving. I'm not exactly sure whether imaging equipment does, but probably it does. Renewable energy devices also 40%. Computers and computer software 40%. Pollution control devices 40%. So these is this a quick idea of depreciation rates. We talked about depreciation rates and depreciation rules. And let me now return to the car leasing business in the country. Car leasing is a very specific business which, because of the tax rules in India, it's developed as a business model. This is so very, unique to the country. It's so unique to India, and this basically is a product of taxation rules. This model, by the way, does not exist elsewhere in the world. It's purely a product of tax rules in the country. Let me explain the rule, and let me explain the rule and the model. But let me also say that years back, I will talk about what's 20 years earlier, when we used to talk about economics of leasing various assets, I would have said car leasing is bekar leasing. I recall having said car leasing is bekar leasing because car in the depreciation rates in case of cars at that stage, plant and machinery was 25%. Cars were 15%. I used to say car leasing is bekar leasing because you're claiming only 15% depreciation. But the way the business has now developed, it's relying on a particular rule of perquisite valuation for employees. Now, this is strangely a mixture of tax reduction by the employer and perquisite taxation by the employees. So the transaction mostly is what? There's a lessor who does a lease to the employer. The asset is given by the employer to a particular employee. Like most companies do, the company owned or company hired a car which is allowed to the employee to be used by the employee. Now, there might be three situations. Either the vehicle, think of a car, either the vehicle is used purely for office purposes. If the vehicle is taken on, the vehicle is provided to an employee by the employer to be used purely for office purposes. There's no question of perquisite there because I can use the vehicle only for office purposes. If the vehicle is allowed purely for personal purposes, then the entire cost is anyway perquisite. There's no question of perquisite valuation rule because the vehicle is used purely for personal purposes. But that both these extremes are rare. Therefore, mostly the vehicle is used both for office purposes as for personal purposes. No employee will actually keep a log sheet because mostly the vehicle is used for coming from residence to office, which by the way is also taken as office purpose, going back to home, which is also taken as office purpose, and then during the day maybe ups and downs, little business visits, etc. It's therefore typically the same vehicle is used both for office and personal purposes. If the vehicle is used both for office and personal purposes, then tax rules lay a particular amount a particular amount which is taxed in the hands of employee as a perquisite. The amount is 1,800, depending on, of course, the engine capacity. But let's think of, let's say, the higher level, or let's say lower level, 1,800. 1,800 is the running cost, is also met by the employer. If the employer does not meet running cost for personal purposes, in that case, only rupees 600. That is, the fuel is not met by the employer to the extent the car is used for personal. I mean, the employer does not pay the fuel cost for use for personal purposes. In that case, only 600. Otherwise, 1,800. So basically, the taxable value of the perquisite is 1,800 per month or 600 per month, depending on whether the fuel for personal purposes is met by the employer or not. Now, please understand that if a car is, let's say worth 10 lakhs, and the employer has taken this asset on lease, say for a period of 36 months, typically you will expect the rent would be roughly about 3% per month. Remember some of the example that we took in the first episode, roughly 3% per month on a 20 lakh car, a 10 lakh car, 3% per month would be good 30,000 rupees per month. The employer will be paying 30,000 per month. Taxable value of the purchase is only 1,800 per month. Employer's cost is 30,000 per month. Taxable value of the purchase is 1,800 per month. Therefore, actually, the employee is getting the benefit of using a vehicle which is actually worth 30,000 per month. And therefore, mostly this 30,000 per month becomes a part of CTC. That is, while fixing the CTC of employees, the employer will take 30,000 as a part of CTC. In other words, if I was targeting paying, let's say, 3 lakhs to an employee, I'll say I pay you 2,70,000 because I'm giving 30,000 by way of lease rentals. In a sense, the employee's CTC gets reduced to the extent of lease rentals, and the lease rentals then adds to CTC to make it 3 lakhs. Therefore, the employer sort of treats the rental as a part of CTC, whereas the taxable value of the perquisite is only 8,100. To the extent there is a difference between the 30,000 paid by the employer and the taxable value of 1,800, well, there is a tax-free perquisite. The tax-free perquisite actually becomes real when the employee is able to buy the car at a reduced value. Because what happens end of the lease tenure, the lessor sells the car to the employee. Remember, the lease was with the employer, but the lessor typically sells the car to the employee. And this sale happens at a value which is much lesser than the fair market value of the vehicle. So to the extent of the difference between the fair market value and the purchase price, there's a perquisite which is actually encashed or sort of tangibly it becomes, because that very day if I were to buy the car say at a price of 10% of the 10 lakh value, which is let's say just 1 lakh, and I was to actually sell the car in for a 5 lakh value, I'll be able to make a tax-free gain of rupees 4 lakhs. Because the employee will then be able to sell the car in secondary market, realize the fair market value, whereas he only paid a 10% price to purchase the car. So that is how the perquisite becomes, I mean, sort of a cash perquisite for the employee. This is sort of hinging on the present rules of valuation of perquisites. It's a business which has become widespread in the country. I'm not commenting on whether this it obviously seems like a tax arbitrage. It's, I think, very clearly a tax arbitrage. But to what extent and to what extent will this continue to prevail? It's currently in vogue with most of the large entities, including MNCs, including big accounting firms. They've all gone for this model. To what extent will this model continue to work, and to what extent will tax officers challenge this is left open to question. I don't want to get into that qualitative discussion, but that's essentially what we had to discuss today in terms of taxation aspects of lease transactions. Let me pause to see if anybody has any questions. Can you please raise hands, and if not, then we will close it for today. Are there any questions at all? There's a question from Mr. Ganesh Pakal. Anybody else who would like to raise hands to say there's a question? Okay. Mr. Ganesh Pakal, you can probably speak your question if you want to.
Yes, sir. I haven't heard about true lease concept in any income tax acts. Can you refer that? What is the true lease and all? And one more thing is, if finance lease is not a true lease, then what is the income that lessor can claim? Sir? Revenue what is the revenue that he should be recognized?
Right. So, the in so many words, discussing true lease as a concept for tax purposes has not come in tax rulings. You're right, but there are rulings and rulings where, based on facts and circumstances, tax claim by lessors has been rejected. There are rulings and rulings. For example, several leases done to Rajasthan State Electricity Board. If some of you were, probably might have heard me yesterday that there was a practice of leasing out assets for a price of less than rupees 5,000 rupees each asset. This was widely prevalent because of the 100% depreciation up till, I guess, 1997 or 99 perhaps. This was a rule long time back. And that time there were a lot of leases of weird assets like electric meters. There are lots of rulings denying depreciation claim in case of these electric meters. Factual, man. It's a factual issue. The meters are not valued. The lessor never looked at the existence of the meter. The lessor could not have identified the actual user of the meter. This was also a sale and leaseback transaction. So mostly it goes on factual basis. But if you're not able to establish the returnability of the asset, you're not able to establish the movability or severability of the asset. You're not able to establish whether the asset actually exists or not. You're not able to establish the value of the asset. Lessor's claim for depreciation is not merely based on title. It's based on the investment by the lessor in the value of the assets. For tax purposes, ownership is not merely legal ownership, it goes to economic or beneficial ownership. On this issue, that the ownership is economic or beneficial ownership, there are many rulings. I think I had mentioned Ayodhya Prasad, the ruling of Ayodhya Prasad. There is also a ruling which is talking about option to buy being given in case of a ship end of 8 years. There also, the matter went right up to Supreme Court. Depreciation was denied. So the true lease within courts has not been discussed by courts, but on um, factual issues, depreciation claim in many cases has been rejected. We try to assimilate the learnings from this court rulings to say what exactly will constitute a true lease. Mr. HM, whatever that stands for.
Harshita.
Sorry, yes, yes, Harshita.
Yes, sir. Yes. Sir, I just wanted to clarify that as you mentioned, the depreciation will be charged under a block. So for, let's say, there's a block of plant and machinery, it has a useful life of 15 years. So when we prepare the balance sheet under the depreciation chart, we show the asset different assets under that particular block of plant and machinery. Suppose that asset is sold after 5 years of its life. Then for the rest 10 years, we will be showing the same asset in the depreciation chart in the balance sheet of that company or not. And the on from the taxation perspective, will we be claiming the depreciation for that particular asset for the rest of its 10 years of life?
I must first of all caution you that we are talking about tax depreciation here, not accounting depreciation. Accounting, the balance sheet chart or the chart next to the balance sheet you're talking about is accounting balance sheet. For
Yes,
tax
sir.
purposes, there's nothing called chart of assets or list of assets for tax purposes. We have opening value of the block. For tax purposes, the way it goes is the opening value of the block, additions made to the block, sales made from the block, and that remaining value is the depreciable value. So for tax purposes, it's entirely based on blocks and not based on individual assets. Therefore, the existence or the value of an individual asset does not matter for tax purposes.
So, sir, for accounting purpose, that asset.
Accounting, the accounting is I am not today discussing accounting. Accounting is what
Okay,
we
sir.
discussed
Okay, sir.
in the last episode. Accounting is, well, asset based, because accounting is based on, there are different dates for each asset. Accounting depreciation is based on useful life of the asset. Tax depreciation has nothing to do with useful life. Useful life has no relevance for tax purposes. Tax depreciation rates have nothing to do with useful life, or in fact, life itself is not relevant. Is the asset there at all? That also doesn't matter. Repeating once again, accounting depreciation is cost of asset minus residual value spread over the useful life. So useful life is the denominator for computing accounting depreciation. For tax purposes, we look at the cost of the asset, apply the depreciation rate given in income tax rules, irrespective of the useful life. So useful life has no relevance for tax purposes.
Thank you, sir.
Sir, if true lease is not satisfied, the financial lease is not satisfying the true lease concept,
Sorry,
then
that's a
who,
follow-up question.
uh,
So, sorry, I missed answering that. If the lessor says my lease is a financial lease, and therefore the lessor is not claiming depreciation, in that case, the lessor will pay tax only the interest component. The lessor admittedly says my lease is purely financial transaction, because in books of account, the lessor will be reporting only the interest component. In books of account, the lessor has not reported the asset as his asset. And therefore, would it be too much of a contradiction for him to go for tax purposes and say, I'll be paying tax only on the interest component and I don't want to claim depreciation? It wouldn't be a contradiction. So it would be consistent with the accounting treatment as well for the lessor not to claim depreciation and not to offer the entire rental for tax, because the P&L of the lessor shows only the interest component. So in my view, if the lessor has treated the lease as a financial lease, then a financial treatment for tax purposes also becomes easy. I don't have to strain to say that why I should not be called upon to pay tax on the entire rental.
sir, then that lessee can claim depreciation and he can show interest portion as an expense in that case.
Uh, Possibly yes. I mean, I would say yes. I would argue yes, because for books of accounts in any way, if the lessee is following India's, a different asset called RU asset will be coming in books of accounts. But since the lease is a financial lease, admittedly between the parties, the lessee should be able to show the asset as his asset for tax purposes, claim depreciation, and claim the interest as an expense. It is equivalent of hire purchase, and therefore the old circular of CBDT or Central Board of Revenue 1943 circular should be applicable here as well. It should
Sir,
not be. It should be possible for the lessee to claim depreciation.
sir, in that case, what and all lessee is claiming as an expense as an interest portion, the same amount the lessor should be claimed as an income.
That's how it is. Somebody's expense is my income,
Yeah, yes, sir. So what and all lessee is paying as an expense as an interest portion, will be
which
claiming
is
as
my
an
income.
income.
There's no revenue leakage, because whatever the lessee is claiming as an expense is coming as my income. What the lessee is claiming as depreciation, I'm not claiming. So there's no leakage at all.
So, sir, is there any case study regarding these kind of cases? Have you come across in your
I
experience?
wouldn't be able to point out to cases right here, but yeah, there are plenty of such. Like hire purchase is a very old settled position. As I said, 1943. This has been the
Okay.
accepted position. And if it's a pure financial lease, which is admittedly a financial contract between the parties, they should, and it's accounted for as such. So accounting
Okay.
treatment coincides with the tax treatment. That therefore it shouldn't be difficult to contend that it's purely a financial transaction.
Sorry, sir. One last question: that if I give purchase option for the lessee at the end of the lease term,
Bargain purchase option, not just purchase option. Bargain purchase option. Purchase option at a
less
value at which
uh,
it's almost certain to be exercised.
or less than the value of the fair market value.
Substantially less. Well, less meaning
Uh,
because we are looking upfront. We are
yeah.
not deciding whether it's a bargain purchase option or not at the end of the term. We're deciding today.
Yes,
That
sir.
is,
At the
looking
end.
forward today is the
Mm,
price such that a
mm.
reasonable person would anyway buy it.
Yeah. If you give in that option, it's a finance lease. Whether it's
Right.
whether it's satisfying the true lease or not.
In my chart showing true lease condition as show existence of a bargain purchase option is a
Uh,
factor detrimental to true sale, true lease.
okay. Okay, sir. Fine. Thank you, sir. Thank you.
Anita?
Sir, Abhirup here.
Uh-huh.
Wanted to understand who will claim depreciation in case of a synthetic lease?
Both parties or neither party? But you're saying synthetic lease meaning one
So
where
it's an
lessor is
operating lease for the lessee and financial
and financial lease for the lessor. Therefore, lessor does not claim it because he says it's a financial lease. Lessee does not claim it because lessee claims rental is an expense. Therefore, neither party will claim. But how is that a problem? Claiming depreciation does not mean there's a big loss to or big gain for the revenue, because lessee is claiming rental, which inherently also captures the principal component of lease rentals, the principal component. But depreciation, after all, is nothing but a compensation for the principal component. So the fact that neither party is claiming it does not mean a huge gain for the revenue or detriment for the parties put together.
Achha.
The lessor is not claiming depreciation, paying tax on interest, which is perfectly fine. Lessee is claiming rental as an expense, which inherently also claims the capital repayment as an expense. That is that's a compensation for depreciation.
And let's say a lease agreement has two terms, a primary tenure and a secondary term. In the primary term, the lease transaction is an operating lease, and in the secondary term, the transaction becomes a financial lease.
No, Abiru, that's a misnotion. A secondary lease is extension of the primary lease. Secondary
So
lease
let's say
is
a second lease. I meant a second lease, not.
second lease is not pre-agreed.
No,
There was nothing pre-agreed. So primary lease got over. There was nothing agreed. Now parties mutually decide to enter into a fresh lease, maybe of the same asset. Right? That's what you're saying. The first lease was what? Financial lease?
Operating lease.
First lease was operating. Second lease becomes a financial lease. That's okay. So first lease was operating.
So the asset will be taken off from the fair value of the asset will be reduced
will be taken off. Correct.
Okay.
If the lessor has now given, it's almost like lessor having sold the asset. No?
Right.
The lease was subject to operating lease earlier, which means it was part of the asset block of the lessor. Now lessor sells it or gives it on hire purchase or gives it on a financial lease, is equivalent of selling. Therefore, that much value should go from the block of the lessor.
Okay.
All right, everyone. So tomorrow we will be meeting for the last episode of this series on the GST aspects of lease transactions, where we'll also discuss the so-called 50-50 rule in case of non-banking finance companies and its impact on leasing entities. And that would be the last of the series, but thank you all for watching today and hope to see you all tomorrow.